What's up, everybody? We've got mid-year 2025 market economic outlook coming at you. Pragmatic optimism is kind of the theme here, with measured expectations going forward for 2025. Got to be realistic, really look at this. And it's been a crazy year with all kind of changes and going on and uncertainties out there, from geopolitical to the tariffs, on, off. Was the Fed going to cut rates? Can they? All that. We're going to touch on all of that. Got a lot of great charts again. You know, I'm the chart guy. Picture worth 1,000 words, that type of thing. And we got stuff from LPL Financial, our broker dealer. Also like to tap into a little bit outside information, such as Carson Wealth Management, who I like a lot from a research standpoint. So got a few charts from them. But I want to dive into this. We got a lot of information to cover. Try to do this as quick as I can because I know your time is valuable and I appreciate you joining on. So let's take a look at this and get into this a little bit deeper on here. So I'm going to cut into this. First of all, let's take a look at the economy. I mean, is the economy entering into uncharted waters that we've seen out here? And a big part of this that we're looking at is that businesses, I'm going to blow this up so you guys can see this a lot better. Businesses report slowdown in new orders. So the current economic landscape is difficult to gauge. I mean, given all the distortions that obscure the truth of the health of the economy, you got a decline that we had during the first quarter of gross domestic product, and then subsequent rebound in growth, really creating a perception of a strong recovery. But we think this is kind of like a false dawn. The whiplash in trade policy is adversely impacting official economic data and creating difficulty for investors of all kinds out there. So it's really tough to look at. And then you've got the report here that you're seeing on this. As I take my cursor, you've got businesses reporting slowdown in new orders. We hit a peak up here really in 222, 23, and it started to drop down. We had a rise back up. And you can see now, the new orders with tariffs and all this stuff is dropping off dramatically. So we've started to get some trade deals out there, right? Then all of a sudden, President Trump's putting a 50% slapping tariffs on, copper out there. And then he's got some deals with India, and then China's still remaining higher. We don't have an official deal there yet. So it's kind of all over the board. And then about the Fed. So the Fed's been stuck. I mean, if President Trump obviously wants the Fed to cut interest rates, right? And you're going to see some numbers on the labor report that just came out, which he wasn't too happy about, from actual reporting being way underreported, that there weren't as many jobs out there as were being reported. So a lot of jobs being cut down dramatically, and they weren't being reported, which has obviously been one of the Fed's things. They're seeing this stronger economy. They don't know what's going to happen with the tariffs. Is that going to lead to inflationary situation? Because they're trying to they want to see that benchmark inflation rate around that 2.5% mark, which we're kind of hovering there now. But we haven't seen this full effect of tariffs yet come into play. So they're kind of stuck in a rock and a hard place. Can they cut it? We had 2 dissenting federal board members saying they'd like to see the Fed cut rates. That's the first time that's happened in a long time. So that could mean some possibility here coming up in their September meeting that we could get the cuts. And LPL does believe we're going to see some cuts by the year end, whether that's 1/4 to 0.5%. Don't know for sure, but we definitely think that's going to happen. I mean, especially after this recent labor report, which was not good. So in this one here, it shows businesses and workers are hesitant about current labor market. So there's 2 things on this. You've got this higher rate on the left axis, which is going up here, 3, 4, and then you got the quit rate. So the quit rate means like the more that people are willing to quit their jobs, the stronger they feel about other options out there. They can move easily. The economy's doing well. It's strong. But when that quit rate starts to drop, and we've seen this drop dramatically since really the peak here after COVID, really dropping way down. We had a little rebound here early 2025, but then it started to come back down here again. So these 2, higher rate dropping and the quit rate dropping, is not a good sign there from a labor market standpoint. And that came out in the the recent thing here that Carson Wealth Management put out as well to kind of substantiate this. So let me back this up one. If I blow this up, these numbers were a lot higher. So this is the payroll numbers that came in for January, March, May, and then here in July reported about 75,000 or so of new jobs that came in, non-farm payroll gains. But these numbers prior to this were being reported as if they were like, I think it was like 200 and something thousand. So there's like a $200,000 job difference that were being reported. And that's why President Trump essentially fired the person responsible for all this reporting. He was not happy about it. So that's a big to-do that, we're going to see this play out in the media and stuff here over the next couple of weeks or whatever. But it's just showing that the labor market's starting to weaken as well. All right, next thing up on the board is recession risk will rise if the tariff rates reach in excess of 20%. So what we've seen for the most part, these ones that have been negotiated so far or working on it, they're all right now coming under, mostly of them under 20. China's still over 40 here, as we know that. I mean, if we get the situation where the tariff rates start going back up, Trump is not happy, we start seeing the increases again, we'll see what happens. But there's also a federal court out there, a judge that could rule against Trump's ability to even to make these tariff calls himself and turn it back to Congress where it used to be overall and get a vote there. So that's interesting. So this is why there's just so much uncertainty, but then there's some underlying good factors out there too that we're looking at. So let's talk about stocks. Path to the upside, a little cloudy with uncertainty. I'm going to pull this up. So the other big thing is just kind of market technical standpoint. What historically has happened? We had a big correction, almost a bear market, when President Trump announced Liberation Day, held up the big board of all the tariffs that were just insanely high. And then we saw a massive correction in the market. We dropped about 18% downward. And then since there, we've recovered back up. But historically, what has happened to the market 6 months, 12 months later when you get these big corrections historically? Obviously, the past is no guarantee of what's going to happen in the future, but let's take a look at this. I think these are interesting to look at. So I'm going to blow these up a little bit more so you can see them on the board here. And this goes all the way back to 1950 in the upper left corner, and then all the way down current day. So the low we had, if you can't see it here, is 4.825. It was down 18.9%. That's actually comes in, I think, about top 3 or top 4 corrections we've had that have been less than 20, but are more than 10% since 1950. And 91% of the time, so literally all the corrections we had, every single one except 2, 1999 and also 2018 finished negative after 12 months, and it was barely negative. But the average upside, 16.2%, guys. The median's 14.6. So half the returns are above that, half below, but the average, 16.2%. So from a correction historical standpoint, usually pretty positive 6 to 12 months out. We're not even 6 months out right now. So we got to, all the way out to next April to see where we end up on this. Big tech, they continue. This is the Mag 7, as they call it. You've got the Googles, the Apples, the Microsofts, the Nvidias. They have been fortunately helping drive the market even with these tariffs, because we really haven't seen the full effect, of the tariffs technically, because that first half we didn't have them. So we've really only had it for 3 months. We'll see what happens here, through the rest of the year. But if you look at these bar charts, this is quite amazing. The Magnificent Seven is in the blue. That's their earnings. They've been actually running, literally, if you look here, Q1, about 30% year-over-year growth. That's insane. The rest of the S&P 500, not quite 10%. So they've been really pushing the S&P 500 up. Obviously, AI is a huge part of that. Artificial intelligence, incorporating a lot of businesses, small businesses, large businesses, individual, lives are impacting this. Is it going to continue? So that's the one thing to look at. Stock valuations seem definitely elevated, but less so, and this kind of goes back to my point before, is that, yeah, the tech stocks definitely are high, those 7, if you will, but from a valuation standpoint on the rest of the market, not too bad, because that could be kind of a Goldilocks theme there from, not too hot, not too cold on that part of it, which could help drive those stocks higher. Because remember, there's 500 stocks in the S&P 500. We're talking 7 stocks of the other piece. Okay. All right, guys. So this is a great chart from Carson Wealth Management Group. Down here on the bottom left is the source on this. LPL Financial or myself are not affiliated with Carson, but want to make sure you know this. They did this, looked at white charts, resource from, they did it on July 30th of this year, looked at 1950 to 2024, the S&P 500 average monthly returns through that entire period. So they looked at the past 20 years since 1950, past 10 years, and post-election year. August and September, not that great. Basically, most of the time, always negative. Now, we're talking like, up to 2%, like the past 10 years in September, down about 2% in the last 10 years. Post-election year, so this year we're running into right now in August, about probably 1 3/4. September down as well. So just kind of pointing out here from a technical standpoint, I'm not talking massive deductions in stock market returns, but here's another crazy report from Carson, which is titled, "There's Something About August." Out of the blue events happen. So you've got Iraq invading Kuwait, Asian contagion, the Russian default in 1998, European banking crisis in 2010, the U.S. debt downgrade in 2011. We came off the AAA rating from one of the rating agencies. The Chinese devalued the yuan in 15, and then you had the Powell remain hawkish at Jackson Hole in 2022. And you get a situation where the markets, we've had some big event drops in August, which is quite interesting. 4%, 6, 14, 9. So there's some big things out there. Not saying that's going to happen, but that's very interesting. If you guys all remember saying Kansas City Chiefs, you want the Kansas City Chiefs to win the Super Bowl, because what happens when Philadelphia teams win world championships? The markets go down. And look what happened in April of this year. So not saying this is going to happen, but I thought I'd point it out. It's quite interesting out there on that. All right, so next thing. Where does LPL Financial see the S&P 500 year end? So if you look in this blue box here to the right, and I'll get out of the way again here so you can see this a little bit better, ranges anywhere targeting from 5,600 to mid 6,000s or so, and we're pretty much in here. So basically that valuation thing, unless we get some push, and some more certainty out of things, geopolitically would be nice. Tariffs officially winding down, the trade war officially winding down. We get the Fed seeing that labor market's kind of coming down. Maybe we get our interest rate drop. That type of thing can help out here to push that higher. But right now, pretty fair valuation, like I said, except for the non-mag stocks. So we'll see what happens here on that. Bonds, the Jekyll and Hyde bond market, a tug of war between economic data and deficit spending. So right now, we don't think you should be very far out on the yield curve. So maybe 1 to 5 years out buying fixed income, because you got a very small spread. Look at this. The Treasury yield spread between the 10-year and the 2 years. They look at the 10-year yield, which is about 436, and then you got the 2-year yield, which is in the high 3s or so. You're not very far off of doing that. And if we do get some inflationary data, things do happen where it turns around and tariffs go crazy again, and we're getting higher prices, then the Fed could actually reverse course, and people may not find U.S. attractive place to invest, selling dollars, getting out of U.S. debt, causing interest rates to rise. So we think you need to play very safe on this, or fixed rates that you can get into. We've got strategies that we utilize. Alternative to treasuries certainly can reach out to us, and we can show you things there too. So Fed funds rate predictions on here, looking somewhere historical and implied market rate. You're on a 3.71 mark eventually it's coming down to. So again, maybe 1/4 to 0.5% by the end of of this year, 2025 is kind of what we're looking at. So with the two members on the Fed board dissenting, saying they wanted rates cut this past meeting here just this week, then if we get this more downward trend information on inflation as well as labor market, we might get those cuts here in September. So if you're thinking about buying something fixed on the fixed rate market, this could be a good time to do it. No guarantees, but if they start dropping the rates, you're going to see other rates coming down too. All right, and what does this lead to? So you got stocks, are they going to make much movement? Bonds, don't necessarily like them. Alternative investments. So this has always been a big theme of mine since really about 15 years back. Right at the point of 2007, 8, 9, and 10, it's just, there's so much uncertainty, things you can't control in the market. And as Warren Buffett says, he's got his first 2 rules of investing. Number 1, don't lose money. Number 2, see rule number 1. So I strive to emulate that, as well as look at some other people. There's another investment theory out there that's similar, kind of Buffett saying don't lose big money, right? Is Moshe Milevsky. This guy's a professor out of Toronto. We track him. Use a lot of his kind of theory in implementing our client portfolios into different buckets of money. And part of that is these alternative investments that strive to allow you to make some nice returns on the upside. We're striving to get double-digit returns. But if the market drops substantially, we give you the ability to either possibly make money on the downside up to certain points and also put in layers of different levels of protection if the markets go down. So we implement a big part of our portfolios into something like that to strive and keep our clients' cortisol levels and inflammatory conditions in the body from going up, which is not good for aging and health. Obviously, no guarantees, but it's nice to keep those client cortisol levels low and still strive to give them the returns they need to pursue the lifestyle that they desire. So alternative investments are a big thing that we use. Give us a ring on that if you want to hear more about it. And we can show you what to do on that too. Policy uncertainty to remain higher. This is another reason for what I'm talking about when it comes to using alternative investments. We've reached some peaks here that track the uncertainty out there, and it's reached some high points here, in June and July. We haven't seen this back. We got it back in 16, COVID period here, late 23, 24. And now creeping back up again, all again pointing to potential, who knows, on the downside. Also worth mentioning here about central bankers expecting more gold and less dollar reserves over the next 5 years. You literally got a lot of central banks buying gold up out there. I think the number went from like 50% to like now over 83%. Of the central bankers expecting buying more gold out there in the marketplace just because of the uncertainty of the dollar. We still believe right now it's going to be the main currency reserve, or the reserve currency in the world, because there's not any other alternative at this point in time. But it's not a bad thing to have a little bit on the hedge side there. And as I mentioned on currencies, you're seeing the dollar here. It's it's retesting its key support levels. We've been running around that 100 mark or so. If it breaks down through, you could see it break down. But if we get some more strong information in the United States, things start looking good. Maybe we're bringing in billions and billions of dollars from these tariffs. We're paying down debt, all that kind of thing. There's a lot of manufacturing coming back to the United States, and you could see that dollar jump right back up. All right, guys, if you like what you're hearing, we can get you access to the #1 financial planning software in the country. Take a look right over here, actually, down below. You'll see where that award is coming from and the backing of that. And if you want access to it, like our clients get access to here, we got all kind of things that we can do on this thing for you. We look at tax planning, retirement planning, investment planning, alternative investment strategies. We literally run simulated tax returns for our clients on this software. If you take a look here, can go multiple years in advance. So we look for planning out 5, 10, 15 years, or we can literally, under current tax law, look at what your tax return would be 5, 10 years from now and plan accordingly for that on here. So if it's something you're interested in, you want a consultation, there's our contact information below. I'm going to throw it up right now, right here. Text us at 513-657-0989. You can also email us at william.wilkins@lpl.com or go to pursuefinancialfreedom.com. That's our website. Click on the Contact Us button. Be glad to help you out. We appreciate you watching. Have a good one. Thank you.
Too many days in the darkness without a glimpse of the light. Running tired and broken and scared, but I swear I'll never give up the fight. I see you broken and beyond.